So good afternoon, and thank you for joining us today. My name is Kobe Kushner. I'm a mining analyst here at Red Cloud. I'm delighted to host another Red Cloud webinar. This time it's on uranium, and we're joined by Anfield Energy CEO Corey Diaz. So during today's webinar, he will provide an overview and an outlook, and then we will take some questions. You can type your question into the chat box at any time, and we'll get to as many as we can. But before we kick things off, we do need to discuss the fine print. So during this webinar, forward-looking statements may be made. I would direct listeners to the forward-looking statements outlined on page 2 of the corporate deck. That can be found on the company's website, anfieldenergy.com. And for Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures on Anfield Energy. And before he wraps up, I'd like to say a couple words here. So the ongoing news from the Ukraine and fear of Russian uranium and enrichment disruption seems to have dissipated. Spot buying has slowed, and there has been downward pressure on uranium prices. So while uranium started the year at $40 a pound, it surpassed $63 a pound last week, the highest it's been since March 2011. However, it has since settled back down to about $52.50. Recent buying from the Sprott Physical Uranium Trust has slowed. The first month of the Ukraine invasion, it had bought about 5.5 million pounds. But during the second, it only bought about 2.5 million pounds to now stand at 55.4 million pounds. Part of the reasoning could be that the market sees less potential for the U.S. to lose access to up to 40% of its uranium supply. As such, the uranium stocks have been hit. Still, mostly up over the last quarter. Many explorers are off between 10 to 15% over the past month. So to summarize, spot market is volatile and exacerbated due to narrow demand, largely from physical buying and traders trying to front run that demand. This is discretionary and beyond market fundamentals. Reasons for the recent price drop are varied, but investors that believe in the Russian supply disruptions are also investors that can quickly shift positions. And prices could rebound just as quickly as they have dropped. So the bottom line is we still like the fundamentals for driving uranium prices higher. With disinvestment in the uranium sector, there's been a lack of exploration and discoveries, and new mines will be needed in the coming years to replace mine closures, let alone cover the growth in uranium demand. So perhaps current prices of over $50 a pound will help incentivize miners to reopen their mines. And with that, I'll now turn it over to you, Corey, to update our audience on Anfield Energy and speak further about the uranium sector.
Great. Thanks, Cody. And thanks, everyone, for joining us today. I'm going to pull up the deck so we can walk through the Anfield story. Just a quick, brief outline of Anfield. We are a company with all of our assets in the U.S. We have the aim to become a producer in the relative near term. We have assets which would allow us to do that relatively quickly. And we feel we're very undervalued at the current state. And we have completed a couple of transactions very recently that I'll get into in the presentation. So Anfield has recently completed a couple of significant transactions with Uranium Energy Corporation. If you're familiar with UEC, UEC is a $1.5 billion entity in the sector, the largest company in the sector, and a leader in the sector. So if you look at this slide alone, this tells this story, the very recent story of Anfield and its transformational move from being a struggling company to one which has significant upside potential. If you look on the left side of the page, our pre-deal makeup in terms of the portfolio, we had roughly 30 million pounds of uranium, but that was split between ISR properties and conventional properties. The ISR properties were subject to third-party production over which we have no control, so there were significant risks tied to those assets. And we still had a significant endowment of vanadium of just under 50 million pounds. In addition to that, we had about $18 million worth of debt, which was tied to two transactions with Uranium One and a roughly 400 million shares outstanding. So we were in a bit of a precarious position, given the debt overhang, and that was creating a lid on our valuation. Following the transactions with UEC, we have roughly the same uranium endowment. However, we now have conventional uranium assets, which are subject to our own production facility. So we have control over production for our uranium assets. And then we've increased our vanadium endowment by a factor of 2. So we're now over 100 million pounds of vanadium within our portfolio, which makes us one of the largest in situ uranium companies in the US. In addition to that, we've removed the debt through these transactions. We've settled the $18 million through a combination of shares and cash with UEC. And post-transaction, UEC will be roughly a 15 to 16% shareholder in Anfield. So it's a significant move for us, removal of the debt, asset swap with UEC to trade conventional assets for ISR properties that I'll get into a little bit later, and then increasing our vanadium endowment significantly, which means that we could be a significant vanadium producer going forward, creating almost a new opportunity in terms of a production base. So as I mentioned, you can see the map to the right. These are our assets. The yellow dot represents Shooting Canyon Mill, which is the hub for us. Essentially, we'll be producing from the blue dots in the area through Shooting Mill, which is one of only 3 licensed, permitted, constructed conventional uranium mills in the US. The red dot represents Slick Rock, which is the asset that we've swapped for with UEC. We swapped our ISR properties for this conventional asset, which has roughly 11.6 million pounds of uranium and 69.6 million pounds of vanadium. So we've traded the same number of uranium pounds in terms of M&I, but we've added roughly 70 million pounds of vanadium to our portfolio. And this asset sits right next to our West Slope properties in Colorado, so there is a significant strong relationship between those 2 assets and the potential of production from that region. Our third important asset in this portfolio is the Velvet Wood asset, which is once again a uranium vanadium asset on which we have a PEA that we put out back in 2016, which has long been sought and thought of as the first feed to the Shooting Canyon Mill. So we now have a conventional asset portfolio constructed, underpinned by a conventional mill, once again, which is one of only 3 licensed, permitted, constructed mills in the US. So here's the transaction structure. I'll start right to left. The debt settlement agreement that I mentioned, we've agreed to pay roughly $9.2 million in cash and issue $9.2 million in securities to UEC to settle the $18 million worth of debt. UEC becomes a significant shareholder, which obviously underlines the strength of our story and the fact that UEC was interested in holding on to a position in our company kind of underscores the value that we believe is within our story now. And in addition to that, UEC has the opportunity, as long as it's holding 10% or more in terms of ownership position in Anfield, to appoint a director. And we think that's important because I think UEC obviously wants to have some say in the future of the company. Certainly they see this as a long-term opportunity, and so we welcome UEC's input in that regard. Secondly, we did have a $50 million capital raise, which was upsized from $12 million. We announced it last week, and a bought deal led by Haywood and Red Cloud. We had significant interest over the $50 million worth of capital available to us, but we decided to cap it because we thought, we only needed so much money in order to address the debt settlement agreement and to add a little bit of money to our current balance sheet. We're sitting on roughly $8 million post financing. And then finally, the consolidation of the assets, as I mentioned, we've done a property swap with UEC whereby we've traded our Wyoming ISR portfolio for Slick Rock. We've gained roughly 70 million pounds of vanadium on the back of that transaction. But once again, we are now able to control the destiny of all of our portfolio, which consists of conventional assets and our conventional mill. Here's another view of the assets that we hold. As I mentioned, the yellow dot represents the mill. Slick Rock represents the traded asset, and West Slope, Velvet Wood, Frank M, and Finley Tank are all conventional assets that could be milled through shootering. And so the mill itself is a 750 ton per day mill. The properties that we do hold, Velvet Wood, Slick Rock, and West Slope, are all uranium, vanadium properties. And so, they've got significant endowment of vanadium on those properties, and certainly would warrant us looking at the possibility of adding a vanadium circuit to our mill. But we do have, now we do have a very strict focus on conventional production out of these properties, a long-term plan underpinned by a mill, which gives us a significant boost when it comes to moving these assets forward and becoming a producer within the next couple of years. It's a capital markets profile. So this is based on the close prior to our announcement. We're looking at roughly 624 million shares post deal, but we proposed a rollback. So post rollback, we'll be looking at roughly 62 million shares outstanding. Market cap at the time of the announcement was 84 million. It's drifted a little bit like most of the other uranium companies in the sector, but it gives you a sense as to where we sit, that kind of 70 to 80 million dollar range, following the transaction. UEC is a significant holder of 15%, the largest single holder. We do have other companies involved and other investors involved, which probably represent another 10 to 15% cumulatively. And then management of insiders is roughly 4 to 5%. Red Cloud's target prior to the transaction was 20 cents a share. So the peer comparison here, I think this is a very interesting slide. You can see that in terms of the valuation, our EV is 75 million. It pales in comparison to the vast majority of companies on this slide. The first four companies listed to the right of AEC are companies which have production-ready assets in terms of having a processing facility and mines available. So you can look at the disparity in terms of our EV vis-a-vis Energy Fuels, UBC, Encore, or UR Energy. UEC isn't a producer today, neither is Encore, but Energy Fuels is certainly a producer. UR Energy is a producer. And certainly this provides you with a sense as to what our potential upside could be when it comes to valuation. The fact that we can consider ourselves part of this group, we think that there should be a significant narrowing of the gap between ourselves and those companies in terms of valuation. If you look further to the right, you've got other companies which have assets in the US and with the potential to produce through a third party, and yet their valuations are significantly higher than ours. So we think that our valuation should be at a minimum in line with the average of the peers to the far right, with certainly the upside to meet at a minimum a UR Energy in terms of valuation. So we're looking at kind of a 5 to 5.5 times where we sit today. So we think there's significant upside. If you look at our asset base, we've got the largest endowment of vanadium. If you look at our assets, 100% in the US, uranium focused with vanadium byproduct and a production facility, I think we're significantly undervalued vis-a-vis our peer. And I think that we have a lot of upside available to investors. So these are the assets. You can see the pictures to the right is actually the mill. We picked this up back in 2015 from Uranium One, 750 tons per day, which is smaller than Energy Fuels, White Mesa Mill. I think White Mesa is about 2,000 tons per day. And I believe Sweetwater, which is the other conventional mill owned by Rio Tinto, is about 3,000 tons per day. We've got nameplate capacity of roughly 1 million pounds per year, but that is something that can be adjusted, through discussions with the state of Utah. Slick Rock, as I mentioned, this is the asset that we picked up from UEC, 11.6 million pounds of uranium, 69.6 million pounds of vanadium. It sits right next to one of our properties that consists of the West Slope project. And speaking of the West Slope project, this consists of 9 historical uranium and vanadium mines. We did put a resource out a few weeks ago on 4 of the 9 mines, and which returned 5 million pounds of uranium and roughly 27 million pounds of vanadium, and then historic resources on the remaining 5 of 3.9 million pounds of uranium and 20 million pounds of vanadium. So there's a significant vanadium resource between those two properties coming out of Colorado. And then finally, the Velvet Wood project, as I mentioned before, 4 million pounds of uranium and 5 million pounds of vanadium were produced from this mine in the past. We have a resource in place of 4.6 million pounds of uranium. The understanding is that there's vanadium there too, given the past production. And certainly we'd be looking to update the resource to reflect that fact. We do have a PEA out on this asset, which was put out in 2016, which returned positive economics, I think roughly $60 million at a uranium price of $65 a pound. So here are some pictures of Slick Rock to the right. You can see on the map to the bottom where this property sits. SR13A, the blue shape to the left of the green shape, that is actually one of our holdings. So you can see how close Slick Rock is to our properties that are in Colorado. So we think that there'll be some kind of some economies of scale when we're looking to produce, within this area. The West Slope project, you can see some pictures. There's a mine. You can see the adit. It's accessible still today. There's an open pit mine on the bottom left picture, JD7. There's past production here. We acquired this from Cotter Corporation back in 2018. There's 1.3 million pounds of uranium and 6.6 million pounds of vanadium produced, at the site. The adits are still there. There's still equipment within the mines themselves. I think to start these mines, each mine would be less than $1 million to get up and running again. Our aim is to get a PEA in place for the West Slope project. We do have a resource already. We're also looking at, putting a resource in place for the remaining 5 assets tied to the West Slope project, and then continue to look for other prospective brownfield projects within the area in order to build up critical mass. And then finally, Velvet Wood. I mentioned we acquired this asset back in 2015 alongside the Shooter Canyon Mill and past production here. We're working on the large mine permit related to this asset. We've got a lot of the work already done through Uranium One, and so we think that there's very little more to be done. Certainly, I think the normal time frame for something like this is 4 years. We're looking at less than 2 years to get this done, probably about 18 months. So we're pretty excited about the prospect of moving this asset forward because, as I said, this is likely to be the first feed into the mill. And so I think in general, our plan is to move as quickly into production. We're going to start producing from one or more of the mines within the next 18 months, in anticipation of the mill being open within 24 months. So we'll have feet on the ground and ready once the mill license has been approved and the refurbishment's been completed to start shipping to the mill. So we'll have a flow of material from day one. Finally, the other 2 assets that we have within our portfolio, the Frankham deposit, which is very close to the mill. It's a relatively low-grade deposit with 2.3 million pounds, which could be mixed with another high-grade deposit in order to realize material from this mine. And finally, Finley Tank is a breccia pipe out of Arizona. So it's a vertical mine as opposed to a horizontal mine. That's something that we could look to produce from down the road or monetize down the road for somebody who has more expertise when it comes to breccia pipe mining. So as Cody mentioned, uranium has had a lift on the back of the Russian invasion of Ukraine. It also on the back of Kazakhstan unrest earlier in the year. I think it's a good reminder to everybody in the market that close to 50% of the material that's in the market comes from places like Kazakhstan, Russia, and Uzbekistan, where there's significant geopolitical risk, especially given what's happening today. There's been talk of export controls coming out of Russia. There's been talks of sanctions being placed on energy assets coming out of Russia. I think it's important to note that a lot of the material that comes out of places like Kazakhstan or Uzbekistan are subject to enrichment through Russia. And so that increases the risk of materials not flowing westward in the form that's necessary to be fed into a reactor. So it's a huge risk, and we've been talking about this for years. That dependence on that part of the world, is something that can be subject to the whims of one person who decides to turn off the switch. And so I think that's had a significant impact in the upturn in the uranium price. And I certainly don't think this risk is going away, no matter what the outcome of the war is. I think Russia is going to be seen as a pariah for a number of years, and I don't think that anybody wants to necessarily uphold whatever regime is in place in Russia in order to continue to get material from that part of the world. So I think on the vanadium side, we've also got a significant opportunity to build out a whole other business on that side related to energy storage and batteries. So that's something we're going to look into. I think back to uranium for a second. You've got the uranium reserve program, which is something that was put in place back in the Trump administration. Has been carried on by Biden and the Democrats, which is a positive because there's always been the concern that the Democrats aren't interested in maintaining nuclear. But now that it's part of the green energy mix, I think it's a positive position and positive for us because that means that there'll be funds available to uranium producers to start and increase uranium production in the U.S. It's very strange to have the largest consumer of uranium in the world, i.e. the U.S., be one of the smallest producers of the material required to keep 20% of the energy grid up and running. And so, we believe that the government's coming around to understanding that there's a big risk of, dependence from overseas in order to keep, significant amount of energy on in the U.S. And so, starting to focus on domestic production is a positive for us because we're one of the handful of companies, that will be able to produce and provide material to the government and also provide material to utilities. Another important point is to note that, we have brownfield properties and that's our focus, properties that have already been produced from or have a resource, historical or updated for NI 43-101. And so these assets are going to be available to, participate in the current uranium cycle. I think the greenfield projects, exploration projects are unlikely to fit into the current cycle. And certainly from a utilities perspective, utilities will contract with those parties who have brownfield projects or a path to production, as opposed to greenfield projects where there's significant risk of those projects being turned into actual mines. So I think we're well positioned given our asset base to sign utility contracts going forward. So just a quick question or a quick comment about management directors. I'm a co-founder of the company. I've been in capital markets for 20 years, worked in equity research. I've been a fund manager and a strategy consultant. And I've been, running Anfield for the past 9 years, through some pretty dire times, but certainly, we've always had a focus on getting assets in-house that we could, turn into something that would create what we've created today, which is essentially a hub and spoke model underpinned by the mill. So conventional assets which allow us to create a long life production opportunity in the conventional side of the uranium market. Josh Bleak, another co-founder of the company, has been in mining for a significant number of years. His family's been in uranium mining for a number of years. He's got public market experience, a former president of a publicly traded uranium company in the past. He's our man on the ground in Arizona and keeps an eye on everything related to the uranium sector for us. Don Falconer has worked in both private and public markets, has been on the board of Energy Fuels, has worked for Ontario Power Generation in the nuclear division, and has been CEO of a publicly traded uranium company. So significant public market experience on our board. We also have Steve Lunsford, who's got 40 years of experience as a geologist and worked for Cameco, very familiar with the assets that we have within our portfolio. Scott Lumadou is someone who's worked in a number of different areas within the nuclear portfolio. ConverDyn, which is a conversion facility, Duke Energy, a utility, Uranium One, which is a producer in New Mexico, which is a trading company. So lots of experience on our board, everyone kind of pointing in the same direction. And we think that we've got the experience that we need in order to move these assets forward at a fairly rapid pace. So finally, just give you a final overview as to what Anfield is and where Anfield's going. We've got a large portfolio of conventional assets in the United States, underpinned by the Shooting Mill, which is one of only 3 licensed, permitted, constructed conventional uranium mills in the U.S. We've got the acquisition of Slick Rock, which once again increases our endowment both on the uranium side and the vanadium side of our business. And we've removed significant debt, which has been an overhang to us for a long period of time. So we think that we're well positioned to advance all of our assets to the point of production within the next 24 months or so. We're very comfortable and we're very excited about the prospect of becoming the next uranium producer in the United States. And, I think our portfolio speaks to that possibility given the past production at all of these assets. And that's it. Any questions?
All right, great. Thank you, Corey, for a very informative presentation. We'll now start with the Q&A portion of this webinar. And just a reminder to everyone on the line that you can continue to type your questions into the chat box at any time. And we've got plenty of good questions already, so lots to get through here. So, there's lots of talk on uranium markets, but let's just take a deeper dive into vanadium. We saw prices spike to $28 a pound after China announced to increase rebar standards. And that was back in 2018. And we haven't really heard too much talk about the vanadium redox flow batteries anymore. Have battery makers kind of given up on these batteries, or does vanadium still have a major role to play in the green energy revolution?
I think vanadium still has a significant role to play. If you look at a company like Largo, Largo is taking, the business into a whole new level, creating its own, business line related to its batteries. I think it's, given, the pluses and minuses related to lithium ion, that had a run for a while. But I think, given that storage is such an important part, when it comes to clean energy, whether it's intermittent power generated by solar or wind, ultimately there needs to be a storage function related to those assets or to any kind of energy being produced. And I think that vanadium flow batteries have actually proven to be, some of the best sources of that storage opportunity. And so we think that there's still significant upside related to this market. It's a small part of the market today. Obviously, steel strengthening is the largest part, but it continues to grow. And so, I think that it's more of a question of timing than need. I think it's clearly needed. I think it's just a question of how quickly the market moves.
Yeah, for sure. And I mean, I don't know, I'm no vanadium battery expert, and I'm not sure how much you know about this, but from what I've read is that vanadium redox flow batteries might be more suitable for storing renewables or stationary storage as opposed to mobile storage or EV battery storage. So do you know what the pros are as compared to traditional lithium ion battery?
I think it's just the storage capacity. I think the storage capacity of vanadium flow is 300 times higher than lithium ion, and that's why there's a city in California that actually used vanadium flow batteries to power the city. That's one of the experiments that was taking place probably a few years back. But that's not something that you could do. The number of lithium ion batteries that you need to use in order to do the same thing is pretty significant. So I think that this is kind of more of a large scale storage opportunity, when compared to lithium ion. You can, if you can run cities off of these types of batteries, you have remote cities that don't really have access to power. In general, I think that's a significant upside opportunity. So I think that's where they're not just competing in the same markets, but there are probably more uses on the larger scale for vanadium flow batteries versus lithium ion.
And so I guess back to the assets now, your growth strategy appears to be more about the development of conventional assets suitable for milling at your existing mill. Do you plan to study how much refurbishment capital it might take to get the mill operational?
Yes, we have an understanding as to what it should cost us, and it's certainly much lower than building a new mill. I think from our perspective, we talked about it in the past that the cost would be between $25 and $30 million to refurbish the mill. And so we think that's very reasonable, considering that back in 2014, Energy Fuels studied the cost of building a mill in New Mexico, and it was about 500 tons per day, and the cost is about $150 million. So that's just the cost. Obviously, it's 2/3 the size of our mill, and that's without the prospect of NIMBYism. Who wants the mill built in their backyard? And so those are, the timing of building a mill, getting through all the red tape, going from the idea down to construction, that could run you anywhere between 5 and 8 years. We're talking about a 2-year rebuild at $25 to $30 million in an existing site. So it's not, there's a mill there. It's not that we're looking to find a place to put it and, hope that the local population, doesn't agree with having it there. So, we think that there's a significant, opportunity for us given our asset base. And as I mentioned, we have assets which have had past production or historical resource or an upgraded resource, and so we're that much closer to production because we're not having to go through the entire litany of concept to construction.
Okay, and so speaking of the mill here, we have a question that they want to know how the circuit works. How are you producing both uranium and vanadium through this one mill?
So you have two different circuits. You've got a uranium circuit, and then you have a vanadium circuit. So the material that goes through the uranium circuit would then flow through the vanadium circuit to get the vanadium. So there are two distinct circuits, and there'll be an additional cost to put the vanadium circuit in place. But if we have over 100 million pounds of uranium, clearly we think there'd be value in having the second circuit.
Okay. And, has UEC already appointed a director? And if not, do they have someone in mind?
UEC has not appointed a director. The transaction hasn't closed yet. So they have the right to appoint a director. As to whether or not a director will be added to us in the near term, we're not sure. But no director has been named.
Okay, and what percent ownership did UEC have prior to the debt settlement agreement?
UEC had 0. It did not have any ownership in Anfield.
Okay, and I guess, looking at UEC's rationale here, do you think that they're hoping to use your mill down the line, or is that not really applicable for them?
No, I think what we've done here is essentially, delineate UEC's business from Anfield's business. So UEC is through the transaction with Uranium One, it acquired Uranium One's ISR processing facility in Wyoming, along with roughly 100 million pounds of uranium. And so we've basically provided them with more ISR properties to tie into its ISR business and strategy. And while UEC is divested conventional assets, which wouldn't really fit into its existing portfolio. So we've basically delineated the type of business that UEC has and Anfield has. And I guess one can argue that UEC could view Anfield as its conventional uranium and vanadium arm, given its investment in Anfield and the fact that Anfield can produce from those mines, whereas UEC didn't have the capacity to directly produce from the hard rock assets that are provided to Anfield.
Okay, gotcha. So that makes sense to me. With the property swap, does Slick Rock suddenly become your flagship? And will you need to refurbish the PEA or perhaps start another study to combine it with nearby assets?
I think we've got, the world's our oyster in that regard. So Slick Rock has a PEA associated with it. Certainly, once we've acquired it, we have to conduct our own PEA. That PEA also contemplated production through White Mesa. We've got our own mill, so we would be looking at the numbers tied to our mill in terms of how to produce from slick rock. So there would certainly be an upgrade on the PEA for that project. We'd have to weigh each of the projects out. I mean, I think there's pluses for each project when it comes to who should be first or which one should be first. And so once we've got economics on all, updated economics on all, then we'll decide. We also have the ability to produce from multiple properties at once. So we're not necessarily excluding or putting slick rock at the back of the line or the front of the line. I think we can look at kind of multiple production opportunities, through any combination.
Okay. And so, with the shift to purely conventional mining as opposed to ISR, how does that change your costs going forward?
Well, I guess there's we look at it a couple of different ways. I think there's a cost to using a third-party processing plant. And there's also the risk of timing of the usage of that processing plant. We have no guarantees. For example, if we're in Wyoming and UEC has its plant and decides that, well, perhaps we want to fill the mill with our own material, or we'd like to make our material a priority, we don't really have a say as to what the timing of our material flowing through that mill would be, or that processing facility would be. Whereas with a hard rock mill, we do have control over how that material flows through to our mill. We think that is it's a factor when it comes to what the potential cost could be to produce through a mill. But we've got a pretty good idea as to what the cost would be to produce through shittering. I think it's also important to note that given the vanadium endowment on our properties, especially coming out of Colorado, that changes the economics greatly when it comes to producing through shittering. For example, given the grade, given where the uranium price is today, we're talking rock per ton of, $400 to $500 potentially coming out of Colorado. And if our costs are in the $200 to $225 range, there's still, this pretty significant margin in place. And so, there's a lot of flexibility tied to that mill, especially given the type of material that we're pulling out of Colorado, especially.
Okay. And, would you consider further asset swaps to help further advance your pipeline of near-term production projects? Is there anything within your portfolio that you might see as non-core to Anfield?
Well, look, we've completed, this will be our fourth M&A transaction within Anfield. And we are always looking for ways, as I said, we're trying to strategically build out an asset base that can be underpinned by the mill. And if there are other assets which make sense to grow that opportunity, we will look at the potential of asset swaps or sales, et cetera. So we're not averse to continuing to do further business as long as it, once again, meets the criteria of being able to advance us either more quickly or more robustly to production.
Okay, and a question here on the resources here. So you're currently in the process of upgrading all your historic resources to make them compliant. Can you do most of this work without drilling? And, when might you be expected to complete this exercise?
Yeah, so, this also underpins our, usual practice of acquiring assets which have historical resource or an existing resource or past production. We have assets that, can be upgraded through data verification. And so we don't have to spend time and effort on drilling unless we want to. These aren't greenfield properties, so we don't have to spend, time and money on drilling. We can just verify data, through an engineering firm.
Gotcha. So that's definitely a good cost saver there, to add pounds on the cheap. So, let's talk jurisdiction now. How does the permitting process differ by state, depending on what you want to do? And, do you have a preference as to where you operate?
No, I think Utah, given where the mill is an agreement state. So it means that you're dealing with the local government or state government as opposed to the federal level NRC. So that's an advantage because you know the people you're dealing with. You've got a relationship with the people you're dealing with. And we've had, one of our former directors has a very good relationship with the state and is helping to advance our licensing process, moving from standby to operating status related to the mill. So that's a great jurisdiction to be in. Colorado is also a good state. I mean, it can be a little more challenging, but once again, these are mines that have produced in the past. So there's no restriction in terms of our ability to start mining there. We certainly need to have conversations with the Department of Energy in order to advance the assets. But once again, it's been done. So we know we're not starting from scratch and trying to understand whether or not the state would allow us to produce from those mines. So that's the advantage that we see with these past producing mines, is that we can follow the same path that was followed before by the previous owners in order to take up where they left off.
Okay, and we have time for a couple more questions here. So when do you expect this deal to close?
So we have until June to get the 2 transactions completed and also the financing completed. So we'd expect to see the financing side of the transaction completed prior to closing the other 2 transactions.
All right, and to wrap it up, Corey, in your view, which upcoming catalyst is going to really drive the biggest re-rating of your stock? Is that going to be once you begin to refurbish the mill, maybe get some lead items in, or maybe start to permit some of the other mining assets? What's going to cause this thing to really re-rate?
Well, look, I think that, first of all, closing the transactions in June will, remove the cap on our valuation. So I think that's a huge catalyst. I think everything that we do beyond that point will certainly should spur value and appreciation in the share price, given that we are moving that much closer to production, whether that's putting economics to the West Slope properties that we put a recess out for, whether that's a refurbished or an updated PEA for Velvet Wood, contemplating the numbers that we have for the refurbished mill. I think that's another potential catalyst, and upgrading the resource related to Slick Rock and the PEA, tying once again into our own mill. I think those are all things that will be a reminder to the investor base that these assets are ready to be used for production. And there are very few companies in the same position that have assets that can be produced from very quickly.
Right, and with that, I think that's a good place to leave it. So, Corey, thank you so much, and thank you, Anfield Energy, and thanks everyone for tuning in and asking a bunch of excellent questions here.
Great.
Red Cloud Securities will be back tomorrow afternoon when Timothy Lee sits down with Blind Nickel, and that's May 4th at 2 p.m. Eastern. Have a great day, and thanks again, Corey.
Great. Thanks, everyone. Take care.